In this video, we are going to compute both the basic earnings per share and the diluted earnings per share. In our example, we have a company that has 800,000 shares of common stock. So go ahead and set up an Excel spreadsheet that looks like this. Pause the video while you do so. So we have 800,000 shares of common stock outstanding at the beginning of the year, and no changes to the common stock are made during the year. However, they do issue 100,000 shares of convertible preferred stock. That is not going to affect the number of common shares outstanding in our basic EPS. It will play a role when we compute diluted earnings per share. The preferred shares can be converted into 200,000 shares of common stock, and this is the potential dilution. So we'll enter 200,000, and for our diluted, we will also be using the 800,000 shares of common stock. So if the preferred shares are converted, the company will have a total of 1 million shares of common stock. And since these were issued on January 1st, the potential dilution is for the whole year. So for the weighted average, it will be the whole amount. The company paid $60,000 in cash dividends. That'll be subtracted from our net income. And our net income for the year was $1,500,000. So the earnings that are available to the common shareholders is the net income less the preferred. The basic earnings per share will be the amount available to the common shareholders divided by the number of common stock outstanding throughout the year, 800,000, or $1.80 per share. For our diluted earnings per share, we will, of course, use net income. However, let's think about the preferred shares. We are doing a what-if scenario when we do diluted earnings per share. We said if the preferred stock was converted into common shares, it would have a dilutive effect of 200,000 shares. Well, we're going to make the assumption that the preferred shares are converted before the payment of preferred dividends, so our preferred dividends will be zero for use in the diluted earnings per share. So our earnings available to the common shareholders will be the full 1,500,000, and our diluted earnings per share is going to be our net income divided by the number of actual common shares and the potential plus the potential dilution of 200,000 shares. So our diluted earnings per share will be $1.50. So again, when we make the assumption of the possible dilution, it can have an impact both to the number of common shares and an impact on net income. If these preferred shares had been convertible to bonds, remember, the interest paid on a bond is tax deductible. So only a percentage, that is 1 minus the tax rate, would reduce net income. Net income, therefore, would not be reduced by the full amount of the interest paid, but you would have to weigh in the tax rate.